Welcome back to another episode of With Sonar. I'm your host, Falasca, of course, joined by Tony Mulvey. We've got a great lineup for you today, especially after taking last week off. But here we are in September. We're almost at the end of the quarter here, Tony.
Yep.
A lot of great things happening. NFL is back on since we've started. My fantasy football is already shot. And we have new data sets inside of Sonar. Did I mention there might be a strike happening on the rails? What more is going on, Tony?
It is a crazy time. I mean, it seems like it's always been this way, right? The last 2 years.
There's no crazy. This is just, it's a day in the life.
Normal, right?
It's a day in the life.
It's supply chain and logistics. There's always something going on. It's just a matter of what, right?
I've been seeing a lot more like supply chain and logistic memes online lately, and it's like, it's like, kind of like the person who's like, fully dressed, put together, suit, tie, everything. First day of logistics, second day of logistics. It's like, like a meme of like, I don't know, like Pirates of the Caribbean, just like totally just like torn apart.
Yep.
A lot of that stuff going around right now.
I can believe it. I mean, you've got, you think about it. You've seen how many new entrants into the market. I mean,
like
whether
20 billion.
I was going to say brokers and carriers, right? They've come into the market and
a lot.
Guess what? Things have changed from what they knew.
Yeah.
And they're moving in a direction that isn't necessarily beneficial for them. So
very true.
It makes it a little more stressful.
Very true. Very true. By the way, do you play fantasy football?
I don't. So that's one thing. I
feel like that would be up your alley. You're the numbers guy.
It's I enjoy it sometimes, but I would put too much thought into it, and that's
fair.
I'd rather with sports betting being legal here in Tennessee, that's more up my alley because then I can focus on 1 or 2 games as opposed to having to sit and watch and understand players. It's a lot easier to understand.
I feel like you're giving our viewers here a little incentive to move to Tennessee.
Yeah, a little.
Or really anywhere that there's legal sports betting.
Yeah, I mean, hey, it's fun.
It's a good time. It's a great time.
Yeah.
All right, but anyways, we've got some good things coming up. So we're gonna touch on a lot of it today. But I wanted to start off here, Tony, because we've got a brand new data set inside of Sonar that we have to talk about, and it's one that I know nothing about. I'm not afraid to admit that. Okay, that's why you're here, Tony. To keep us straight. But you're going to explain it to me, and then I'm going to translate that and explain that very simply to our audience, because that's what I'm here for.
Perfect.
Yeah, good plan. So this is the Mark Cube Freightwave Supply Chain Tech Index. Big words there, Mark Cube. Tony, what is that?
So Mercube this is a partnership Freightwaves and Mercube did. Mercube creates a lot of indices around stocks and like that go on to be traded as ETFs and things like that. So similar to what you would think of the S&P 500, the Dow Transportation Index, like things like that. That's very similar, but this is just taking a look at. There's nothing that focuses on supply chains. If you really look at like the Dow Jones Transportation Index, some of the companies in there aren't what you would consider supply chain companies, right? I mean, there's like an Avis. Yes, the airlines do some cargo, but a vast majority of their revenue is from passenger movement. So the airlines are included in that. And this kind of takes out some of that. And we use kind of the FreightWaves, the Freight Tech 100 the list of the 2023 Freight Tech 100 came out today. We use that kind of as a jumping off point, right? These are the companies that industry leaders think of as innovative, and they're where investors are parking their money. Right. The problem with that index or the Freight Tech 100 is they're not all publicly traded, right? So there's a lot of that private investment. But this gives away in those supply chain companies that are investing in technology that are publicly traded and have an average daily traded. I mean, there's nuances to it. They have to be over a $500 million market cap.
Right.
And they have to have $3 million in average daily traded volume. So, I mean, there are levels that these companies have to make, and some of these newer entrants in the market don't necessarily reach that yet. But over time, this index will evolve. But you've got on the screen, you'll see 2 different lines. So the blue line is that price return. So just the index itself, that's the price of what the index would be as a whole. The green line is that total return. So stocks in this index do provide, some of them provide dividends, things like that. Those count into your total return. And that's why you see that green line higher than the blue line.
Yeah, all about them divvies, especially right now when the market is doing so well.
Yeah.
Great time to buy.
Yeah, so I mean, this is just a way to kind of gauge investor sentiment in supply chain technology. I mean, again, these are some of the biggest supply chain companies in the world, but also those that are innovating and coming up, being somewhat disruptors to the industry. And I mean, it's broken down between pure play and then non-pure play inside the index, about 80% in that pure play freight tech space, 20% in the space that they benefit from some of this technology, but they may not necessarily be the innovators of it.
I think it's great because there hasn't been a lot of eyes on supply chain really up until the pandemic hit. I mean, we can see on the charts there. I mean, look at the index; it was basically flat 2017, 2018, 2019, and then as soon as 2020 hit, obviously we kind of had a little springboard down, and then as soon as that dip hit, up and to the right. And I know that happened with a lot of sectors, but it's nice to see that supply chain was kind of taken along with it. Because I think there's, and obviously we've come down like most things have this year, but there's, I think it'll be interesting to see as more and more investors want exposure to the supply chain market, supply chain technology, which, like you said, has largely been overlooked.
Yeah, I mean, that's the key. And there's not really been a good way to get that exposure to it other than obviously going and picking out individual names. This kind of lumps it all together across the entire industry. And like I said, it's a lot of those companies that are in that Freight Tech 100 are still relatively, I don't want to say small. There's some very big companies in that that are still privately held, right? So you think about it.
Freightwaves.
Yeah, maybe.
Yeah.
But as you think about it, I mean, as these companies mature and enter that public market, whenever that may be, and
like
they meet those thresholds, they'll be included.
Yes.
So I hope one day that is where we are at.
Yes. I'm partly joking, but at the same time, like that is a goal. Freightways does hope to be there at some point. But yeah, we've got making great progress.
Yeah.
And I think we'll get there. But it's exciting to see that's almost could be a potential. That's like a journey. It's at least there's a goal now.
Yeah.
Right? There's a little bit more tangibility to that aspect of it.
Yeah, I mean, people talk about getting included into the S&P 500, right? I mean, that was a big talk with Tesla and things like that. So I mean, it is something. Now there is that. I want to be included in this index. How do I get there?
Right.
Again, some of it has to do with the market and size and things like that. But other parts of it are getting to that point. It's almost like clearing it's an accomplishment.
So if we want to get exposure to this marquee index, we just Venmo you our money at Tony Mulvey, or
no? I mean, to go learn more about it, go to obviously Mercube. They've got it listed. We've got in the Knowledge Center, and then on the website where we release the press release. But that's where to go learn more about it. So
do not Venmo Tony. You will not get your money back.
I'll give it back. I'm a nice guy.
Anyways, no, that's great. That's exciting. I'm curious. I know there's not a lot on it yet because the indexes are on the newer side, but I think it'll be exciting just to kind of see where it goes. I mean, that's really the journey from here. So we'll give you an update when we learn. Good question. Does it just bounce back with the general, stock market when that happens? Or, does it fall further, or does it bounce back sooner?
Yeah.
We'll find out. Next, so we gotta jump into the market, right? We just had Labor Day, right? Not long ago. And traditionally, Labor Day is a little bit of a bump. That oftentimes kind of signals the bump into busy season for the freight market, especially domestically here in the U.S. I don't think we're seeing a busy season, Tony.
No.
I know we've kind of hinted at that, but it's more and more the data is confirming that.
Yeah, and I mean, this is a time when you think about the freight market as a whole, right? You'd start to position inventories for that busy retail season. And what you're not seeing is really that happen, right? I mean, volumes pop back just a little, but I mean, look at rejections, look at rates, where they're at, and you're just not seeing any signs that it's going to go higher. Now, there's a big caveat in this. You mentioned it to start, potential rail strike. That could throw a massive wrench into this everything that we talk about, right?
Yeah.
Because it could, if the rails strike, you could end up having all this volume that was going on the rails. Well, now shippers, they're opting for the rails because rates are cheaper on the rail, but they have so much inventory. Well, now they've got to move that stuff still. I mean, it's not going to just sit somewhere. So they're going to have to put it back into the truckload market. And then guess what? That's more volume. It's going to tighten capacity again, even with this. I mean, it's just if this big if, and like how big does that impact if it does happen? That we can't really say, but it is one of those things to keep an eye out for, because it could send this market back up to, I don't say to where it was, but higher than where it is now.
Yeah, at least stop the falling knife.
Yes.
If nothing else, and falling knife might be an extreme term, but I mean, it's still unconfirmed if we have found a bottom yet.
Yeah.
So that'll be interesting. I mean, let's just pull up truckload rates here for just a minute, right? I mean, this is something that we've been looking at for a while. This is nothing new. You guys, if you're viewing here consistently, you've seen this before, but just to reiterate, that blue line that you see, those are your dry van truckload contract rates in the U.S. Over the last year. This is line haul, by the way. No fuel is included for this example. And then the yellow line there are your van spot rates over the same period of time. So that's that high frequency spot rate data. Now, we finally, in the last 6 weeks, I think have begun to see a consistent downward move on some of those contracts. We have kind of flatlined in the last week and a half, 2 weeks, that blue line that you'll see there. And I think that's kind of like that first step down in contract rates. But by no means is that, if those spot rates, that yellow line continues to stay down at that level, those contract rates aren't staying there.
Yeah, I mean, I think we did the math on it. Donnie, Gilbert, and I, we talked about it. If you adjusted the 2019 rate for inflation to where it was now, it's that spot rate, the NTIL, I think it was $1.88. So, I mean, we're at $1.91 right now. So, I mean, you're basically adjusted inflation contract rates or spot rates are almost equal. Where that contract rate still $2.75, like you mentioned, it's a step down. We talked about it on this show before, right?
Yeah.
It just takes some time for those contract rates to catch up.
Doesn't happen overnight.
Yeah, I mean, it's how do bids happen? Are the bid cycles 3 weeks? Are they 6 months? Are they a quarter? Are they a year? Yeah. And when are they occurring? And how long does it take to implement? So it's more of a timing thing than it is directionally. Odds are we're going lower.
Right, exactly right. And I think, and this is where we come back to peak season, right? Because we can look towards certain signals, right? Peak season is really driven by volume, right? I mean, it's, this inventory rush goes from the ports to the warehouses, distribution centers, to eventually the stores to get ready for that shipping season. But there's already so much inventory there, there's less freight that needs to be moved. Still freight, there will always be freight that needs to be moved, but just that peak, that urge, there's less of it. That's not to say that there won't be any increase in rates, right? I mean, that's holidays, right? Less, there's always a little bit of a bump, but I mean, if we pull up the volume chart, I think it paints a pretty clear picture as to where we are. By the way, look at those bubbles. Look at all those little chat bubbles. Too much?
No, I think it's good to call out. I mean, I think the big one, right? I mean, we did pump back after Labor Day, which is good, and I mean,
but we expected that. If you look though, that big bump that you see there, right there, it's kind of that jump up on the dark blue line, the blue shaded.
There's a tick down.
If you look at the green and light blue line above it, so 2020 and 2021, and then you look at the orange line, which is 2019, they all did that.
Yeah, exactly. So I mean, it was expected, and I think what was interesting to me was how much higher we went than where we were before Labor Day. But when you think about where Labor Day kind of falls in the calendar, right? It's right off at the end of a month, then right into a holiday weekend. And that's kind of, you'd expect this, right? Yeah. Shippers are moving things. And again, it's not really a surprise. It's more of, what does this do in the next, say, 3 weeks, right? As we close out 2 weeks now, as we close out the quarter, right? I mean, do we see it act kind of like 2019 where it flattens out and then dips at the beginning of the fourth quarter? Or do we see it dip now and then gain some strength in the last week right to the end of the quarter like it did in 2020 and 2021?
Yeah. No, that's a great point. I mean, in 2021 also there really kind of like it kind of peaked out here for the rest of the year and it never got higher from here. It only went lower, right? But in 2020, it was the opposite. It kind of built into that big surge right before December.
Yeah, and I mean, some of this, I think Rachel Premack put it, she had a chart in her newsletter last week that had inventories and sales quarter over quarter, or quarter Q2 over Q2 of 2020 over 2022 over 2021.
Words are hard.
They are hard. And what you saw was inventories, like the growth in inventory way outpaced the growth in sales. And so what's that say? I mean, it says these shippers have way too much stuff on their hands, right? So like you said, that time sensitivity nature is effectively gone.
Right.
There's nowhere for them to move things. And I mean, you see it in retail locations. I was in a store the other day, and you could just see there were just boxes in the middle of like aisles because there's just nowhere to put anything because the back of their store's full. But the back of their store's full because they've got to clear out room in a DC to get it into the store.
Yes.
So to bring in new things into the DC. So it's just this. I mean, it's the bullwhip effect.
100% the bullwhip effect. And that's not to say, like, there are isolated items that are still kind of behind with some supply chain challenges, right? So that exists, right? But at a whole, most things there is excess of right now. But again, and that goes back to that even though there's an excess today, and maybe there will be for a whole nother year or more, we don't know, right? The data suggests that there will be an excess for a while. But if we have a problem getting inventory again for a while with this rail strike, if that happens, that won't take long for that inventory build up to potentially get dwindled out some.
Yeah, I mean,
and that could cause a shock to the system.
Yeah, absolutely. And I mean, there's other factors that can go in there that can cause it, right? I mean, you start to look at some of the consumer data, right? And this is what I look at one in particular, and it's revolving credit, so credit card debt. If you look where we are now, we're up 14% year over year. We used a bunch of stimulus money to pay off debt during the pandemic, right? We're basically 3% higher than where we were before the pandemic. But we've erased all of that debt that we paid off. We've erased all that, or added back all that debt and then some. And I think that's the concern for me. I mean, you'll see delinquency rates. To me, they almost seem like a lagging indicator, right? I mean, once you've got the Fed raising interest rates, which causes the cost of debt to go up, you're taking on more debt. It takes time for consumers to go delinquent on these credit cards. So it's not going to be an instant reaction. And I think that's one of my concerns going into the holiday season is this shift from cash to credit, and we'll see how it works out. But I mean, you look at savings rates too; they're at the lowest level they've been in more than a decade.
That's right. So. Very true. And that's the one concern that I have with folks who reference government data sets. They're incredibly valuable, but they're so lagging in the market. Even if they update monthly or quarterly, oftentimes they aren't measuring that month or quarter that they are updated for. They're very far behind in terms of the data that's being measured. But this is great. This is exciting, right? This is why Sonar exists, so that you can see whenever none of us knows what's going to happen tomorrow. But when it does happen, we can see it immediately, and it takes the guesswork out of it. And that's the exciting part of it all. Let's pull up our rejections real quick. I know we haven't looked at rejections in a while. But this, I think, will be exciting, especially as we look at those different modes. I mean, right, because all the modes operate differently. We know that. Van and reefer have kind of been on a trend there. By the way, that pink-purple line, that it's hard to read there, I take full responsibility for that one. That looked a lot better when I made the chart. Now that I see it on the big screen for you guys, not so great. But we labeled it, so hopefully that helps. So blue, this is over the last year. Blue is van, nothing surprising there. We are down and to the right. It's still falling. It is still falling at a slower pace, but it is still falling. So bottom's not in yet on van rejections. Reefer, we have found a temporary bottom where they dipped slightly below van. They've bounced off the bottom and have been flat for the last couple weeks. Flatbed, on the other hand, is that green line. So was running up for about 6 months while van was coming down. But then it's since March it hit its peak and it's been coming down at a pretty quick rate.
Yeah, I mean, we use the flatbed one to kind of show what's going on in the industrial economy, right? If you look at housing starts, industrial production, things like that, it tracks pretty darn close to what FOTRI does.
It really does.
That's a shout out to South Turk. I'm sure he'll love hearing a FOTRI reference.
FOTRI.
But you are seeing it down, and I mean, you start looking at some of this data. Housing starts have been down last few months. Industrial production was down in the last release I saw.
Oh, yeah.
Guess what? We're seeing it in real time.
The flatbed data, yeah.
What's interesting to me in this chart is how low reefer rejections are, right?
Yeah.
You said the bottom, they're 6.78%. If you go back to 2019, I don't think they dipped below 7%.
No.
I know they were. I mean, the reefer market's typically always tighter than the van market. No different here, but I think it's just how low they are relative to what you would think would be normal.
Yeah, it definitely seems like they're pushing the envelope.
Yep.
And this is kind of where I wanted to call it Labor Day too. Like, it might be hard to see unless you're watching this on your phone, but that green line, you can't even see a Labor Day bump in the van. Blue. You can't even see one. You can, if you look really closely, you can see one in the pink line, the reefer, right? And you can see a little bit of one there in that little jump up that you see at the end there in the flatbed market. And then it's just a couple of days later, it's almost gone.
Yeah, I mean, and that's kind of telling of what the market is right now, right? I mean, it is
shakes
just
it off.
Take whatever. Carriers are effectively just accept, right? I mean, I was talking about it. I mean, if you looked at intermodal rejections, right, what the rails do, I mean, they're effectively auto accept. They're at like 1%, but they're always that way. That's what they do.
Yes. When
you see trucking companies where you see these rejection rates get to this 5%, it's almost the same thing because there will always be natural rejections because it just doesn't fit in the network right now.
Right.
Things like that, capacity is out of place. Like that'll always happen, especially in the trucking market compared to the rails where it's a little more controlled. But I mean, it's effectively auto accept on the van side.
Yeah. And almost on the reefer side.
Yeah.
Almost.
Yeah, I mean, it probably, at that level, it probably is. When you think about just the difference in how much capacity there is on the reefer side compared to the van side.
And flatbeds maybe like a body length away from auto accept.
Yeah.
It's still not quite there.
Yeah.
Right? They still have a little bit of leverage, but
it's definitely not what they had at the beginning of the year.
Oh, yeah, beginning of the year, they were
40% rejection rates. Yeah.
You were killing it. Yeah, no, 100% makes perfect sense. Yeah, and that's done. I want to show one last thing though, because I think this will be surprising. It's we're going to look at, we've been talking about the market going down a lot, right? Mm-hmm. But with this, and really with the volatility of the last 2.5 years, there's been so many changes to the market. Now, what I want to look at is where has volume shifted at all in terms of where some of these markets basically have the advantages or disadvantages. Yep. So let's go ahead and throw up this map real quick. I don't think I've ever shown this map on with Sonar. Or at least not the particular data filter on the map. We've shown the map before, but this map is currently filtered with outbound tender market share on a yearly change. So what that means is you're looking at the year-over-year change in outbound tender market share. So outbound tender market share, very similar to volume. Volume just looks at, for lack of a better term, right, the need or the loads. The market share represents how much of the overall market, what percent of volume a market has.
Yep.
So, for example, I think Atlanta and Ontario, California go back and forth for the largest market. They typically float between 4 and 5% of all truckload volume flows out of those markets. This is looking at the year-over-year change. So the blue are the markets that have gained market share over the last year. And the red are the markets that have lost market share over the last year. And the white is unchanged. So Ontario, unchanged. LA, lost.
Yeah.
It's lost a little bit. And these aren't huge changes. This would be like 0.5%, 1%. But still, like that adds up.
Yeah, it does.
Especially in a market like LA where there's who knows how many thousands of loads they go out of there every day.
Yeah. Well, I mean, one that stands out right across the border, Phoenix. If you talk, you talk to a carrier, Phoenix isn't great. Well, now you look at this and you're like, well, Phoenix has gotten better, right? There's more volume now than there was this time a year ago. Or they've taken more share in comparison to markets around it, right? It's not, all the volume's not getting sucked up into Southern California. There is some now across the border. I mean, look at Detroit.
Yeah.
It's standing out too, right? But that's a market that's been volatile, right?
This is when we were talking about stocks earlier, right? The stock market is down. We know that. This is the equivalent of, like, if the S&P is down like 20%, this is essentially telling you which stocks are down 30% and which stocks are down 10%.
Yeah.
Phoenix is one of those that's performed better. While it's probably gone down in volume, not as much as the rest.
Yep.
Right? Versus like, it looks like Harrisburg, PA, it's gone down way worse.
Yeah.
That's like your gross stock right there. That like balloon. That's like your Zoom stock. No offense, Zoom. I love the product, but apologies for the stock. So, anyways, we are right about at the end of the time here, Tony. We will not see you guys next week. We will see you the following week. But if you are going to be at CSCMP Edge in Nashville next week, come look for me because I will be there. My team will be there. Tony will not be there because he's got to do the important work. But we'll see you the Wednesday after that, live 3:30 Eastern time. Take care.